Okay guys, so the purpose of this video here is to get you familiar with, the purpose of this video is to get you guys familiar with financial statements. And so what we're going to do here is we're going to take a look at all these different transactions that we've been recording throughout the book. At least this is the example of all these transactions, and here we recorded, based on the accounting equation, how they impacted each one of these different accounts. These four here are assets, accounts payable as a liability, and then we have stock, dividends, revenues, and whatever expenses that we have are going to be equity items. Okay, so after every transaction, notice we are calculating a balance, right? And we go all the way down, and at the very end, on the last day of this accounting period, this is the balance. We have $9,000 of cash, $1,000 of an accounts receivable. Remember, that's like an IOU that people owe us. We have $500 of supplies. We treat those as an asset because we haven't used them yet. Once we use them, then they're going to ultimately become an expense. And we have $20,000 of land. We have $200 of liabilities, $30,000 of common stock. We have dividends of $5,000. Our service revenue balance is $8,500. So you remember up here we had one transaction of $5,500. Then we tacked on another $3,000, and so this is what our ending balance is on the last date, right? So this is like the last date. $2,000 in rent expense and $1,200 in salaries expense. So when we put things in financial statements, the reason that we're doing that is because we want to have something nice and pretty and easy for the users of the financial statements to take a look at. Just imagine if Walmart, if we had, you know, a zillion pages of transactions and stuff like it, it would be a mess, right? So what we're going to do is we're going to take these ending balances and we're going to put them in the form of these financial statements. Okay, there's a couple of them we're going to talk about, and we need to prepare them in the same order that they're presented. If not, you'll see it would actually be kind of impossible to do it. So I want to skip over here and let's take a look at the first of the financial statements, which is going to be known as the income statement. Okay, so this is an income statement. Now this is based off of those numbers that we were talking about just a second ago. So remember, the service revenue was $8,500. Basically, all the income statement does is it says how much profit or net income did we make over a specific period of time. In this case, it was for a month. So it's important that a company generates revenue, but it's also important that they're able to control their expenses, right? So if you had a lemonade stand and you brought in $25, but you spent $26 in ingredients, you're not doing so well. That would be a net loss. If we made more via our lemonade stand than the cost of the supplies, then our revenues would have exceeded our expenses and we would have had a profit. So that's basically all this is. We just look at what all of our revenues are. Service revenue, that's what we charge people for providing goods or services. And we're going to subtract from those all of these different expenses. And expenses are the consumption of company resources in the pursuit of generating revenue. So basically, how much did we earn and what were our expenses? And the difference is going to be known as net income or net loss if it is a situation where we have more expenses than income. Hopefully we're going to see net income and not net losses. We also need to have a proper heading on this that involves firstly the name of the company, the type of financial statement it is, and this here we need to know if this is for one day, for a month, for a year, etc. Okay, so this is, basically this is like out of all of our sales, I guess we could think about it this way. Our sales exceeded our expenses by $5,300. Now this number here, we're going to have to pull this one into this next financial statement. I like to think of this, the next one we're going to see, this statement of retained earnings, is kind of like a financial statement that links the two more important ones together. I guess they're all very important, but the income statement and balance sheet are ones that in most people's minds are maybe a little bit more important than the other ones. So this next financial statement we're going to see in just a second, its purpose is to kind of link those two together. Okay, so here's the statement of retained earnings. You remember that $5,300 from right up here, the net income? Well, we need that. We need to plug that in. So basically, with the statement of retained earnings, it's pretty easy to put together. We're going to have our once again, we're going to have our heading, and we're going to have for the for the month ended for the period of time. And typically, if our income statement, whatever period of time our income statement is, we're going to have the statement of retained earnings would be for the same period of time. We have our beginning retained earnings. It just so happened to be 0 here. This could have been 1,000, but in this example it happened to be 0 because this was the beginning of the Smart Touch learning business. So we say beginning plus net income minus dividends gives us the ending retained earnings. The ending retained earnings from one period is going to become the beginning retained earnings for the next period. So for example, this is for the month ended November 30th. When we do a statement of retained earnings, if we were to do one for the following month, for the month ended December 30th or December 31st, we would start out with $300 up top instead of 0. So don't think that a statement of retained earnings always starts out with 0, because that's incorrect. It starts out with whatever the beginning balance is. We add net income and we subtract out dividends. This ending retained earnings figure is going to be the one that shows up on the balance sheet. Sometimes when people are trying to assemble their first balance sheets, they have trouble, they struggle, and they want to use this beginning number for some reason. That's not the case. We're always going to use this ending number. So here's our balance sheet, and we can see here on the balance sheet that here's retained earnings. We brought that one from the statement of retained earnings. So remember, we had to prepare the income statement in order to prepare the statement of retained earnings in order to get this number right here. Okay? And it tells you that here in the little notes. Our balance sheet always has to balance, obviously, or it wouldn't be much of a balance sheet. Now this is taken as of a specific point in time here, right? November 30th. This isn't for the month ended. So it's kind of like if you looked in your checking account, it would tell you your balance as of a specific date. Likewise, this balance sheet is of a specific date, unlike the statement of retained earnings and income statement that are for a period of time. So we have cash here, we have accounts receivable, office supplies, and land. Cash is almost always going to be listed first, okay? And these are all of our assets. We're just taking all of those balances that we saw in the opening couple minutes of the slide, and we're just categorizing this stuff. We add these up and it equals $3,500. We have one liability, and then we have our common stock, retained earnings, and we add that up and we also get $30,500. Once they balance, then we do this little thing, we put a double underline underneath of them. Now, I just want to mention that typically the place where people mess up, the hardest number to come up with is this 300 number right here. It just happened to be 300. This is our ending retained earnings. In order to get that, you have to prepare the income statement and statement of retained earnings. These other numbers we can just take from elsewhere. They're just given to us. So if you're not in balance, retained earnings is a good place to start, because I have a feeling if you look, you'll figure out that the dollar amount that you're out of balance by has something to do with you either using the wrong retained earnings number, or perhaps you've made a mistake somewhere in those other financial statements. Let's take a second now to talk about the last of the 4 financial statements, the statement of cash flows. Now remember this $9,000 cash number here, because what this next financial statement is going to show is it's going to show us how we get from the cash balance on one balance sheet date to the cash balance at the next balance sheet date. Okay, so basically what it does it would give us information like how much cash did we have. Let's say we had $6,000 in November 30th, 2015. The statement of cash flows would show how we got from what we had last time we prepared the balance sheet to how much we have now. So all it shows is cash that's coming in and cash that's going out. If it did not involve cash, it is not going to show up on the statement of cash flows. Only things involving cash are going to show up there. Okay, so here's the statement of cash flows. Once again, we need to put a proper heading, the name of the company, the name of the financial statement, and once again, this one is for a period of time, for the month ended. So in this case, like I said before, a statement of cash flows, it shows whatever we started out with. I used a different number, just making an example up a second ago. But here we can see that this was the first month of business that we were in business. So we started out with $0 in cash. The purpose of this statement is to show how we got from $0 of cash in the first month to $9,000 at the end of this month here. So this is for a month. So we started with 0. How did we get to 9,000? Well, once again, this only involves cash. We received cash of $7,500. And then we had payments that went out. Okay, so these are for payments of things that we might think of like as expenses. So we have cash. We're going to have this statement's going to be broken into 3 different categories. Cash flows from operating, so operating, investing, and financing. So all we're looking at is cash. We had cash that came in for services that we rendered. We had expenses that went out. We purchased land. We issued common stock, which was a cash inflow, and then this is an outflow. If it's in parentheses, remember, that means negative. So on the statement of cash flows, that represents an outflow. When we total all those guys up, we're looking at an increase in cash of $9,000. So we started with 0 plus 9,000 gives us 9,000. So for the next month, we're going to start with 9,000, and then we're going to have cash that comes in and cash that goes out, and we're going to end up with another number. It might be like 15,000 or whatever. And this statement, the statement of cash flows, will show us how we got from, in my example, 9,000 to 15,000 bucks. So it's very useful, and this ending number is always going to agree to what is on the balance sheet. Sometimes this statement of cash flows tends to kind of throw people off, but once again, just remember, its purpose is just to show if you were to put 2 financial statements, like a balance sheet for the same company for 2 years side by side, and you looked at the cash balance, there's going to be different numbers there. And the purpose of this financial statement is just simply to show how did we get from what we had in 1 year to what we have in the next year. Okay, now this is very important because as you're going to begin to see, under generally accepted accounting principles, we're going to use something called accrual-based accounting. That means we record revenues when we earn them, even if somebody's going to pay us later, and we record expenses when we consume the resources or when we incur them, if we're going to pay them later. Okay, so it's based on when revenue is earned or expenses are incurred. That's when we record revenues and expenses under this thing called accrual-based accounting. So the statement of cash flows is very useful because managers are able to kind of tweak the numbers sometimes using accrual accounting, but this kind of shows the meat and taters of what cash is coming in and what cash is going out. In the long term, there should not be a huge difference between the sales and the cash receipts. If that's the case, then there's a collections problem. Okay, so we'll talk a little bit more about all that later. Let me know if you have any questions, and have a great day.